the Reserve Bank in its financial stability report has really highlighted some of the risks associated with the housing market, and it said that these risks are accumulating and it could do more to restrict mortgage lending. But at the same time, the Reserve Bank gave the impression that it was going to sort of sit back for a bit and wait and see what the impacts of the current new policies, wait and see what those impacts are. Is there any urgency at the moment to put new lending restrictions on?
Well, I think you've described the story quite well. What we've seen is a housing market that has been growing very fast and stretching itself when some of the underlying forces possibly are moving more slowly. Population growth slowing down, and the prospect that you can sustain these price rises is a bit more questionable. So we've been, of course, taking action. The government's been taking action to try and moderate the housing market, and our most recent actions are only just came into force this past weekend with the 40% deposit requirement for investors has only just taken effect. So we are waiting to see how those impact the housing market, hopefully do moderate it and slow it down, and that does give us a bit of time to before we need to decide whether we need to do anything further or whether we will actually see a consolidation and those risks ebb away. So yeah, we do have a bit of time.
Okay, and just to go through some of those timelines, in the document the Reserve Bank goes through how long it might take if either A, LVRs are extended, or B, the government gives the Reserve Bank some new tools that it can use to restrict mortgage lending. And if LVRs are extended, the Reserve Bank needs 3 months, and if some of these new tools like debt to income ratio restrictions or restricting interest only lending, if those are used, then it needs about 6 months to consult. Now that is from the time the government decides to even give the Reserve Bank those tools, should it even make that decision. So are we talking about DTIs only coming in say 8 months at the very earliest, if that's what you decide?
Well, I think it really is important that we take the time to consider the effects of these policies and who they impact and what the benefits and costs are, to do that really thoroughly. So we've done a preliminary assessment of this, and we're going to give government advice about that later this month. But then it would be really important to take the public with us, to consult with them if we do propose to make introduce some new tools or wider changes. So yeah, there is a lead time, and then there's an implementation time for all of that to be there. So I'm not trying to make it sound like it's going to take forever, but you do want good policy to be in place and policy to work well, and that's we're still seeing the existing policies work their way through. So I think we've got a window where we can take that time to develop good policy and to take the public with us, and that's what we're trying to do. All the time, hopefully people out there are getting the message that to be cautious, that prices just don't go up forever, that they shouldn't want to be just jumping into the housing market because they fear a price rising in future. They should be thinking about what's the long-term trends here. Population growth is lower, maybe interest rates will rise in future, maybe there's a lot more building going on, supply is happening, so maybe the housing market actually is already starting to move and might be a good time to wait.
I'm interested in this tension that the Reserve Bank has on the financial stability side of things, because on the one hand you don't want house prices to fall, or not too much at least, because that makes the system affect stability, but at the same time the more they rise from such ridiculous levels, then that makes the system unstable as well. So which way are you leaning? Would you rather them keep rising, or would you be happy for them to fall a little bit to make the system more stable in the future? Now obviously it's a massive question, but I don't know if you could provide any commentary around which way you're leaning.
Well, I think that the FSR, the Financial Stability Report, was actually indicating we are wanting to lean against the house prices rising. We are getting a little bit more worried about the fact that they're rising when underlying forces are probably moderating. So in that sense, that's why we are trying to get ahead of it. That's why we've tightened the LVRs in 2 steps. from in March, and then again more recently. So, and of course we're part of a bigger picture. There's wider government policy changes as well on tax and trying to ease the building constraints. So yeah, we've got a bias at this time to be cautious about them getting too far away from their fundamentals. It's not like I think they're, we're at immediate risk of a massive crash, but if you get a shock to the economy and the prices have got out of line with fundamentals, then there's more chance they will fall sharply, and we'd rather avoid a sharp fall by tightening now to lean against further rises.
Is your bias, just to be clear, is it you'd rather prices rise more slowly, or you'd rather prices fall a wee bit?
Well, I think what we're trying to do is evolve the understanding of where they are relative to their long-term fundamentals. Now, preliminary work is suggesting that they're rising or starting to get a bit stretched relative to where those drivers are heading, those drivers being population, supply, long-term interest rates. So that does lead us to a bias to say, well, if they're starting to stretch away, then they need to come down towards that. And it's not a view about a specific number or and whether they should fall within a month or 6 months. It's sort of saying you'd expect them to be closing that gap over time.
So does that mean? I just want to know whether people should accept that maybe prices do need to fall, or is that not what you're saying?
Well, if they could continue to be adrift from where the fundamentals are,
which, in all due respect, I think most people would think they are.
Well, it's interesting because we look at we think they probably are, and they're sort of risking stretching further away. Just
to jump back to some of these tools, debt to income ratio restrictions is the tool that the Reserve Bank favours of the new options that it could look at. Now, Grant Robertson has said that he's worried that these tools would make it more difficult for first home buyers to get on the ladder. Now, I'm just wondering if Grant Robertson came back to you and said, yes, you can have DTIs, but you need to have an exemption for first home buyers or for owner occupiers. Would the Reserve Bank still be interested in that tool, or was it sort of like blanket or nothing?
I think we're still working through the design and the assessment of these tools. So let me couch my remarks in the sense that we've done some preliminary analysis and we think this tool has some benefits and helping to moderate house prices and reducing financial stability risks. And we think it impacts probably more heavily on investors. More of the high DTI borrowing is by investors than it is by first home buyers. Generally speaking, they're not as many first home buyers have high DTIs as investors do. Nearly 70% of investors have a high DTI. So
that's more than five times?
That's more than five, yeah. And it's not to say 5's a magic number, but it's just it's a benchmark to think about. And so when we're doing that preliminary analysis, we think it can bite in a way that has more impact on investors. But we've got a lot of policy work to do. What would be the impact if we exempt it, or could we create a speed limit or some sort of partial exclusion or allow some through? We frame it from what's our objective. Objective is to support the stability of the system, to lean against the risks that people borrow more than they can possibly cope with if an interest rate rises, if they lose income, and then who's affected, and is this implementable, and all those sorts of things. And we haven't come to a view about at this stage about whether we would target particular groups. That's work still to be done. But what we have done is look at and see actually it would bite more heavily on investors, in the first instance. Okay,
and LVRs, in the document, the bank says that the differential, so the different rules, so currently with LVRs they're a bit tougher on investors than they are on owner-occupiers. It said that if you feel like you need to do more to regulate mortgage lending, you could make it even more tougher for investors. I don't know if you could provide any figures around that, whether, say, a 50% LVR, would that be something that you'd even consider? For example, require most investors to have a 50% deposit. Currently it's 40%.
Well, it's in the realm of possibilities. I mean, when we say we think we could, we obviously do think about where would you go from 60. You potentially go to 50. But we also, what we said and painted the picture in the report more broadly is that probably the marginal benefit of keeping on tightening LVRs is a little bit questionable, and probably you just don't get as much gain from additional tightening. It deals with a particular sort of risk where you get a sharp house price fall and people haven't got equity in it. Well, a 40% equity is already quite a good protection. Possibly the bigger risks that we have are serviceability risks, where people lose their job, where interest rates rise, and that's why a DTI might be better. So you sort of think, you've got one tool in place, what's the best next step, and perhaps the complementarity of having this other a debt servicing restriction could be actually a better combination. So that's part of that further work and analysis that we're trying to do. And of course, again, all in the picture of we'll be doing things, and the government's also thinking about its broader packages.
Geoff, I know you've been asked this question a number of times, but do you regret removing LVRs last year?
And I've said a number of times that I don't. Look, policy has to be in a context, and has to be about where the risks and the orientation of economic and financial momentum is. When the pandemic hit us, and we were at the worst of trying to work how to support the economy, what to do, we did a number of things to try and remove impediments to credit, impediments to business and households, make it possible for as much as possible for the economy to hold its way up. Removing LVRs was part of that. It was part of making it easy for banks to restructure mortgages, to do things with people in terms of deferrals of payments and interest, and not to worry about whether somebody was flipping into a just over the 80% margin, because now they were deferring their principal and their equity was going to be lower or something or other. So those circumstances, we did what we needed to do to support the economy. We were surprised how quickly it bounced back and how strong the housing market recovered, if you like, or lifted in the latter part of last year. But we responded. We put the restrictions back on.
On that, some people will think, well, you took them off so quickly. I think you consulted for a week from memory, and then it took a long time to put them back on because you had to consult for a longer time. And could you not have put them on faster? If you could consult for 5 days or a week to take them off, could the consultation not have even, say, been a month to put them back on?
Well, it's an interesting question, isn't it? I mean, in one sense, the process of consulting about your impact on people is you're removing a restriction. So it's really not harming people, generally speaking, to do that. So
depends who you're talking about.
Yeah, but more particularly, it's just easier for banks to implement in that way. And the whole implementation timetable, what happens is when you're putting it back on, really it's the applications in process that are the awkward part. So people have had pre-approvals. I've said you can get this loan, and then we go, oh no, you can't. So you're changing processes in midstream unless you provide a window for the banks to manage through the existing processes. So all of those things come to play, and it takes a bit longer to put it on than it does to take it off.
Could you not just say if you have pre-approval, that pre-approval stands? It's just for all new approvals.
Potentially, but then we need another information management system and have to monitor to that separately. So I guess this comes to regulations have to be able to be enforced and implemented, and they keep changing the rules. It gets harder to do that, and how are we going to say with a bank, you didn't comply with this new set of rules, and we didn't really have the information. So it just gets a bit awkward. We got caught with Christmas as well, as in there in the consultation period and time frames, and I understand the desire that we move quickly, but also we move, as I said earlier, we want to move with the public, having an understanding of what we're trying to do and being confident we're making regulatory decisions with the appropriate thoroughness and care, and not just sort of, doing it. We did move fast to try and respond to the pandemic. I accept that, but tightening up, restricting people's access to credit, you take care and about.